The way you predict the future, you've got to watch the cash flowing.
Most people don't know this. In fact, I've never, ever heard anyone talk about this.
Because most people have no financial education, their cash keeps flowing out.
Right now, we're at the top of a 75 to 100-year long-term debt cycle. But when you get to the top of one of these debt cycles, the only thing the government can do, well, there's 4 ways out of it. Number one, they can choose austerity, which very few governments do, and that's just tightening the belt, spending less. Everyone feels the pain. Think of the deflation or depression we had in the 1930s. Or they restructure the debt, or they could just default, say, hey, we're not paying you. Or what most governments do is they choose money printing. This is creating inflation to bail out all the people who have the debt, whether it's governments, whether it's individuals. So once you get debt to a certain level, you've got to, well, you don't have to, but most governments choose to inflate it away. So what does that mean for the average person? Well, if the government is going to try to create inflation, meaning the cost of goods and services going up, what you want to do is you want to make sure that you're positioned for that. So as an example, if you just own your own home, you've got to make sure that you've got a 30-year fixed rate mortgage. Because if they try to create inflation, if interest rates go up, then your interest rate is going to go up unless it's fixed. And what happens when you're a debtor and they create inflation, you're going to have the opportunity to pay the loan back, your mortgage, with cheaper devalued dollars. So the way they can think about that is if they borrow, let's say $100,000, the rate of interest means that they're paying the bank back with increased purchasing power because you've got principal plus interest. So what happens in inflation, though, is inflation allows the borrower to pay the debt back with less purchasing power. So if your rate of interest, let's say, is 1% or 3%, we'll call it, but if inflation goes up to 5, 6%, the delta between those two is a transfer of purchasing power from the bank to the individual homeowner. And I think a lot of people listening to this probably have a mortgage, if not on a rental property, on their own home. And I think that's the very first thing they can do to be proactive. Also, gold, silver, Bitcoin, you talk about that all the time. And I could continue to go on, but that's where I'd start. Let's just say that you've been saving your money, you've been working hard, you've been doing all the right things, and you go to the bank and you're like, oh my gosh, they're only giving me 0.5 interest or 0 or who knows what it is. You can't even see the interest rates. They're so small nowadays. So you say, okay, where can I go to get a little bit higher rate of return? But I still want to be safe. So then you might look at a product like a money market mutual fund or a money market fund. And then you look at this, you say, well, that's safe. All my buddies are doing it. It's just like a bank account, but I get maybe a 1.5% return. Well, what the average person doesn't realize is they're taking exponentially more risk just to get that 1% additional return. So how is that? Because the way that the money market mutual fund gets the additional return is they take your hard-earned savings and money and they put it into the repo market, or they put it into the commercial paper market, which is basically funding for corporations, the same type of thing. But does that person really want to lend their hard-earned savings to Deutsche Bank, to HSBC, some of these banks that could be crumbling as we speak? Would that individual want their money being lent to American Airlines or Boeing right now, where every single time you turn on CNBC or the TV, you see that they're asking for another bailout because they're about to go bust? That's how this macro, and that's how the cash flow that Robert's talking about, that's how, just one way that it can affect the everyday person.